I love, love, love your note, the summation of academics back to Fama and French, and it's real simple. You say the diversified portfolio structure of bonds makes this bond market and this bond bear market, it could be different.
It could be different. I think that there is certainly we have to consider the extraordinary circumstances that have gotten us here. So we just have to keep that in mind, and just relying on sort of long-term constructs in the global financial market linkages, we need to be rethought a little bit in the wake of the pandemic and the policy response, both monetary and fiscal, that have occurred over the past 18 months or so.
Vishy, let's focus on China just for a moment. Property developers dominate the high-yield dollar bond index over there. I think it's about 2/3 of it. We've seen it start to bleed from Evergrande to other property developers. I want to understand from your perspective, when you wake up on a morning like this, where you're looking for signs of contagion beyond the property developers in Hong Kong and China. Where do you look for that right now, Vishy?
In fact, it's interesting what you just said, John. The first thing I looked at this morning was a Bloomberg report, in which, I might not be pronouncing this name right, Guangzhou or RNF Properties, which is another property developer, was able to raise $2.5 billion by borrowing cash from executives and selling a unit. And to me, I read this the first thing in the morning, and I felt that maybe the expectations of a broad spread contagion may be overdone. I think that clearly the impact on growth is there. But I think the key point here is I continue to believe that this is not a moment like what we had in 2008.
Vishy, do you think that it is a good idea to go in and buy the bonds of Evergrande, or perhaps not Evergrande, but other developers, since at this point you think it's overdone?
I think you have to it's a bond by bond decision. I wouldn't generically say just go buy everything. It's a bond by bond decision. But I think it's important is to follow the point I wanted to highlight is that in the midst of this growing signs of contagion that everyone is talking about, a significant company was able to raise $2.5 billion of cash. That was notable to me. So, I'm quoting right back to you from Bloomberg.
Thank you, Vishy. I appreciate that.
You can come back.
But the idea to me here is a really important one. The idea that you're saying, it's time to start looking as to when to buy the dip. And you're not the only one. I mean, pretty much across the board. I was looking at analyst notes, and they were saying, perhaps don't buy Chinese developers yet, but maybe go to Chinese tech sectors. This bet that policymakers will ultimately step in and stem the pain. Can you keep betting on that, or are Chinese regulators sending a very different message?
There has certainly been a subtle change of signals from the policymakers in China and I think a lot of that we think is already reflected in price and in the expectations of the market in terms of the growth outcomes. And we continue to think that this will be managed by. There is certainly a change in the policy, no doubt about it. But that policy change, the subtle shift in policy, we think is largely in price.
And that's the financial risk. Talk to me about the economic risk in all of this, Vishy. Is it different?
It's a bit early days to determine if it is substantially different. I would leave it at that.
Why, Vishy? Why is it too early? When we can see what the property market means to China and Chinese GDP, can't we just make some assumptions now that this is going to lead to slower growth out of China?
Our Chinese economists think that we have already troughed in terms of growth, and I continue to stand by that.
I look, Vishy, where we are, and we've got a reset for next year. You've been doing this for a few years. How far out are you able to look now with some form of confidence in setting up an Excel spreadsheet, of doing a sensitivity analysis? Can you get out to the third week of November, or dare I say, can you wander into 2022?
Well, I think we have to wander into 2022. Fortunately, we have the bond market, and we have that tells us something about the expectations of what the market is thinking on a go-forward basis. So certainly, you can imply, what the bond market is thinking, and then make layer on top of that your expectations of what the policy is going to be. I'll give you an example. If you look at what the bond market is thinking in terms of the number of hikes after the first hike. So, we can imply that information from the bond market, at least get a sense of it. And we think that the bond, you can see that on Bloomberg. There's a Bloomberg function, MSP1KE, MS Pike. That you can see the number of hikes that the bond market is expecting after the first hike is done. And we'll get a glimpse of that, effectively the same thing from the dot plot. And we think that there is a substantial deviation between what the dot plot is telling us what the pace of future hikes would be versus what is the price in the market, and we think that the market will move towards the Fed. So when we do have to think ahead. We are not just thinking about what's happening next week, but there are a number of things that we can rely on to see what the market is, what's ahead of us. And I think important is to be flexible as underlying data change. We should be willing to change our views on stuff.